Hello. In this investor overview, we look at what's in store for investment between now and the end of the year, and start by looking at why it's hard for governments to get it right. Let's get started. The 2008 crisis was a credit-side crisis that was severely prolonged by a lack of confidence. Many firms did not get new loans to grow, their credit lines were not renewed, and so, in order to avoid going bankrupt, they cut back. Many people have lost their livelihoods and, as a result, banks have had to cancel many private loans in addition to business loans. Practically all banks were cooperative with the customer, but it was not that the debtor did not want to pay, but that he could not, so there were not many solutions. It is also difficult to pay a loan from nothing and difficult to buy any product. This has spread the problem to previously untouched areas. This is the deflationary cycle that all governments have sought to stifle at its roots. That is why governments have chosen a different solution now than in 2008. And that was nothing other than large amounts of money. Almost simultaneously with the emergence of the COVID quarantine, they started to push incredibly large amounts of cheap money into the economy. They did this to protect jobs and keep the economy going by giving people money to spend. It was impossible to spend that amount of money all at once, if only because of the quarantine. While jobs were generally preserved, money was looking elsewhere and finding its way. And we have seen this in the significant rise in exchange rates in almost all areas. The downside of the abundance of money is that inflation inevitably follows. The more money there is, the higher the inflation. To contain it, the amount of money available must be reduced. One way of doing this is to raise the base rate. This is what was expected from the Fed and the European Central Bank to do in 2021. The current situation is very complex and inflation must be contained without pushing the economy into recession. The response line is very thin, so it has to be carefully balanced. Many financial experts have different views on the right solution precisely because of the complexity of the situation. Having reviewed this, let's look at the area of equities. As the base rate rises, interest rates on loans creep higher. The uncertainty shown by central banks and governments about the solution is also creating uncertainty for businesses. And rising funding and unpredictability is encouraging them to delay investment, with a knock-on effect on share prices. A bumpier period for equities is expected this year as a result. But that doesn't mean that if you're looking to plan for the longer term, now is not a good time to get in. The reason is that governments need to find a direction they believe will stabilize the economy by the end of 2022 and the beginning of 2023. Also, companies cannot wait indefinitely to develop. As a solution, they can either price in higher costs or take a risk, or the market will pass them by. Some sectors have already shown an upward trend and are expected to continue to do so until the situation changes. But what are they? The first is the technology sector. Their share price collapsed at the beginning of the year, but that didn't put companies out of business, there was just a sharp correction. Whether this can be seen as a correction is a matter of opinion, because the Nasdaq's decline at the beginning of the year is strong enough to be a correction. But from the bottom it is very easy to go up a lot. The next sector is energy, commodities and related sectors. Energy prices are rising, which is less good news. The question is whether the economy will be able to absorb this level of price increase, because if not, history will repeat itself and we will have another crisis coming from the direction of energy prices. High energy prices, on the other hand, have had a positive impact on the revenues of the companies involved and, with them, on their share prices. The winners here are not only those companies that deal with gas specifically because of its role as an energy carrier, but also those that process it. This is why fertilizer producers have also done well. Last but not least, companies that are market leaders are also emerging as winners. They have a pricing advantage and are able and willing to pass on the increased costs to consumers. This makes it less of a problem for them to have to raise prices because of rising costs. These companies are among the value stocks, most of all the largest ones that have a well-established brand name and a sufficiently wide consumer base. Let's also turn to what we can expect for equities in general this year. We remain in the bumpy phase, which is a long-term entry point for you after proper selection. Governments and central banks are expected to take a stance on what fiscal policy they wish to pursue towards the end of the year, and from there we can expect companies or even whole sectors that successfully adapt to this to start to move upwards. A good advice is not to wait until you see a recovery in the news and signs of recovery in everyday life. By then, stock prices will have already started to move up. If you want, we can help you get started. See the link in the description to get in touch. Next, let's look at the big picture geographically. Let's start with the United States of America. The dollar strengthened on the back of the Fed's interest rate hike. Up to now, we could be happy about this, or say that the dollar is their money and they set their own interest rates, just as no one has a say in the interest rates of the foreign except our Hungarian central bank. The dollar, on the other hand, is a global currency and many investors invest in dollars. You can see the first consequence of this when you look at the fact that many countries are indebted in dollars or trade in dollars. Interest rate rises and the rising dollar exchange rate also have an impact on the repayment of dollar-denominated loans. This in turn affects other countries. The dollar strengthens, meaning that they have to spend more of their own currency for the same dollar. And interest rates rise, which means they have to pay more dollars for the same loan. In a nutshell, by raising interest rates to fight inflation, the Fed is indirectly interfering in the functioning of other countries. The other consequence of interest rate rises is that the yield on U.S. government bonds also rises. Even though the bond market is still not attractive enough for investors in the current inflationary environment, given that real yields are negative, the rise in their yields has an impact on the expected return on other investments and hence on the demand for them. A rise in the Fed base rate will not only change the yield on bonds, but also the yield on real estate. This is partly due to rising price increases and partly due to rising lending rates. The next important area is China. Last year, the Chinese stock index did not show a big rise, but rather sideways. This was due to China's internal reorganization in addition to its COVID quarantine. The Chinese state has restructured its own education, its real estate market, and its data management policy, among others. In addition, it is focusing on catching up rural, underdeveloped areas to reduce inequalities. Also, to reduce inequalities, it expects more social responsibility from the large companies it has supported so far. This is only a precursor to growth, but not ideal for the growth we are experiencing now. And this year is even more downhill. The reasons for this are already elsewhere, and they are mutually reinforcing. One of them is that the Fed's cycle of interest rate hikes, and the rising U.S. yields that go with it are reducing demand for Chinese investment. The other is that the Shanghai area has been shut down due to the epidemic, which has caused significant damage to the economy, and that U.S.-China relations have been strained for some time, with many investors pricing in the possibility of Chinese companies pulling out of U.S. stock markets. As you can see, while China may be a risky investment in the short term, but it is an opportunity in the long term. After the storm clouds have passed, if it only grows to where it started, that can be profit for you. Finally, let's see what's new in the home country. At the moment, the issue of inflation has several components. In Hungary, imported inflation is the main determinant of the aggregate inflation rate. For this reason, it is also important that the foreign exchange rate should moderate, whether measured against the dollar or the euro, but the opposite seems to be the case. The exchange rate is currently at historic highs. You can also see the damage of this when you enter the market as an investor in another country or buy anything at home, because the price increases of imported goods are being passed on everywhere. But you also see the damage if you're just going abroad on holiday. To curb inflation, the central bank raised interest rates again on 1st of June. This took it to 5.9%. This is quite high compared to the previous almost 0%, but in a longer historical context it is still a moderate level. That is why, when borrowing for example, You should be prepared for the fact that further interest rate hikes are still very much in the cards. The high base rate also affects lending rates, and this in turn has an impact on the housing market. The price increases already mentioned for U.S. real estate are also being experienced here at home. Here too, it is the result of a combination of rising labor costs and rising prices for building materials, which in itself is reducing demand. This is why we expect a slowdown in house price growth this year. Real estate was also discussed in the section on market cycles, in the context that it behaves like equities with some phase lag. You can observe this now. As the money has flowed out of equities and the banks have not had such high interest rates on loans, and you have also been able to get all the existing subsidies that you were entitled to, so that the house purchases have had a bit time of a run out. But this slowdown is based on several factors. The first of these is the fall in demand. With the current rise in lending rates, repayments are also rising, which means that the bank can approve lower loans for the same income. This in turn leads that you need to have much more own money for a property that is already priced higher. The other option is for the buyer to bargain to lower the purchase price or look for another solution. The price of building materials has also seen a dynamic increase recently. As many of these have to be imported from abroad, the rise is not expected to stop yet. This also encourages prospective buyers to make a more considered, financeable move. The other trend is a strengthening of supply. Like everything else, real estate is affected by the supply side. Construction that has already started is either completed and sold at current market prices, or the money invested is lost. For many people, a previously taken out, for example, a baby loan has run into a blind alley. In many cases, the quarantine has not worked, and the couple has decided to continue separately. Since they no longer have this money, they can pay back the money they borrowed by selling the property. Last but not least, there is the impact of central bank and government actions. This has an impact in both directions at the same time. After all, it can also affect the interest on existing loans. For example, because the moratorium will end on 30th of June. Or simply because the interest period will end and the bank will recalculate according to the contract. In most cases, this will lead to an increase in repayments. If the debtors cannot pay this, they may have to sell the property out of necessity. The market does not follow the phasing out of subsidies and discounts. Buyers will have to finance this themselves. The result is the same as if buyers could get the property at a higher price, with more required capital and higher repayments. If both the buyer and the bank say yes,